Good afternoon. Welcome to Green Bicep. This is week number 15. We are at April 13th, 2023. A lot has been going on in the last few weeks. Year to date, the market is up 8%, and we've had a recent rally in healthcare, utilities, energy. Overall, the market is down year over year, about 5%. For the S&P as well as for the NASDAQ. The market continues to be in a chop. Those performing well have been Bitcoin, gold, and most recently healthcare. Both Bitcoin and gold are a great hedge to quantitative easing or expansion of money supply. Inflation is dropping quickly. We'll review PPI and CPI. Core is at 3.48% for core CPI. The Fed aims to raise rates, and the market has rate cuts priced in. I project a market of S&P of 3075. That may not happen until next year, the way things are playing out now. That's a PE of 14. The market is currently at 18. We'll review that as well. Initial jobless claims are beginning to rise. That is showing weakness in employment. The regional banks are going to report next week, and JP Morgan reports tomorrow. So what folks will be watching are deposits and, in general, loan loss reserves, as well as just their net interest margin as a whole, their profitability. Lending has decreased. This is probably the most important thing on here that folks are not talking about. If loans are not given out, that economy will contract. That is a guarantee. That will also decrease inflation too. The housing data is coming out next week. I expect it to be weak. And most recently, the Pentagon files were released. I guess they've been filtering out and pushed to certain media sources. And ultimately, they provide intel that the intel community doesn't want shared about Ukraine, assets in the government, and such. And China has been meeting with a lot of diplomats. We know China met with France last week, and they continue to meet with folks. So that the Chinese are being very proactive in expanding their relationships and fortifying their aim for the next decade. So at the highest level, the market continues to be in a state of influx or chop as the yield curve is inverted. So this would mean that you want to protect your assets. Most professionals are not fully invested in the market. They are probably partially invested. And that is subjective to your risk tolerance. So here we have the graphs that I showed last week. This is updated, and we can see the NASDAQ has rallied, sold off a little bit, while the advanced declines continue to be weak. So I expect when we do get a pullback, the NASDAQ is going to be the weakest of the indices. The Russell Microcap has been quite weak as well, where the S&P has climbed up while the advanced declines followed. And that's what you want to see in a healthy market. You can see some pressure in the NASDAQ 100 QQQs, which is dominated by Apple, Nvidia, Tesla, stocks of that sort, Amazon, and that sold off. But today there was a bit of a short squeeze going on. The market wasn't being very rational, and so we pushed up. So my projection with the earnings is based upon Dr. Yardeni's model here, and basically he shows our current market price with around 4,000 on the S&P 500 with the EP of 18. I think it's realistic if we could get down to around 14, which is a little over 3,000. And just depending on the Federal Reserve and how long they hold rates higher for longer will determine how low this contraction will go, because earnings will continue to struggle if cost of capital stays elevated for too long period of time. For those companies that have a lot of debt, it will pull down. They won't. Prior, they would be doing stock buybacks. They will have to cut back on that and instead have to pay more in a higher interest rate. Those with floating debt. The market overall, when you look at bonds, you can see the 10-year was at 3.4%, but we'll start and look at the 3-month is almost at 5. Well, the 30-year is at 3.64. So the yield curve is inverted, and you can see it here. With the 30-year, you get a lower interest per year versus if you purchase a 3-month bill today. And that is a sign that the financial markets are in disequilibrium. They're not acting healthy. And I've been saying this for a while, and this could last for sometimes for a few years. Then you get typically a major crash. The longer this is held out and the longer it stays inverted, in my honest opinion. So we have services here, and hold 1 second. I just want to have my notes. So anyhow, we have services here, and you can see services have ISM services have dropped down, an ISM Purchasing Manager Index, and essentially this is the Purchasing Manager Index is a survey of company executives in the state of how they see essentially their line of business specific to ISM Institute of Supply Management, which is more geared towards manufacturing in general, but there is a services component, and that contracted as well. So overall, these executives the trend is down, so they're not very optimistic on the outlook. So they obviously are seeing orders weaken and inventories beginning to build. And then we go to the Fed. Why is this happening? Well, the Fed is raising rates, and because of the raising the cost of capital, it's ultimately raising inflation, and this is driving costs up, and this is putting pressure on everybody. And these are the guys in charge without Powell. So the inflation data, you can just see CPI was 5% year over year, was 6 prior, so things are improving. Same difference month over month. It went from 0.4 to 0.1, so it's decelerating the month over month change in inflation across the board year over year as well. And here, headline CPI at 5% year over year. You can see the trend is clearly down. You can see core CPI excluding food and energy is at 5.6%. And core services ex housing was at 0.29 per Michael McKee, which annualizes at 3.48%. So what does that mean? It means inflation's dropping. The Fed shouldn't be raising rates, because what the Fed is doing now, it takes about 12 months to flow through the economy. So they're going to be putting everybody in a bad situation this same time in 2024. So seems like that's when the gloom's going to hit. So I had this last week. Brazil PPI basically is looking at inflation more from a production perspective versus consumer, not retail. And boom, US PPI came out, and boom, it dropped from 4.9 to 2.7. So we could get deflation. Actually, I expect this is gonna go negative, unless the Fed does some sort of surprise rate cuts, which the market has built in, and they have no plans to do so based upon what they've said. So this will go negative. Michigan sentiment and expectations. I haven't put this up in here a while. I'm just, the point here is showing that this is consumers surveyed, and it began improving, but now we're turning over again. And inflation expectations, though, are improving. So there's like, people are happy about inflation, but you know, the trend is up here, which is the positive. This is critical, is bank lending. And the reason why is the economy survives off of lending. If you don't have lending, the economy will slowly close. And you can see there's been a turnover, what's been trending down actually quite a bit since July. And then it looked like there was a little recovery, but it turned back over. And so this doesn't portend well for the future. And then we got commercial lending, industrial loans. You can see it flatlined and it's actually starting to contract. So that means if that's contracted, everything else that is a function of loans, businesses, all that, supply chains, capital stock, building out infrastructure, that all will come back. If we don't have infrastructure, you're not going to have a good lever on GDP growth, true economic growth. I threw this in here, the Restrict Act, because essentially if this was passed would allow the government to spy on Twitter. Not that they're not doing it now, but it would just give them full access. If someone felt like stroking a pen, you would lose more privacy. And this is a good recap. Profits are coming in. We had housing orders all top and fall over, and now profits are falling down, so we'll know more by the end of this quarter. But it looks like next quarter might be where the most damage is done. We'll see. I mean, the economy, things are holding together, but it's now, let's continue to float through this. But you see the banks, this bank went bust, this bank went bust, this bank basically went bust. So this one, CMA, they're on the list of potentially going bust because they have a lot of unrealized losses. Well, a lot of deposits over 250K. I don't know. It's just in this quadrant by Michael Burry. You could talk to him. And the regionals are reporting next week. So I would expect a lot of them to move, 5 to 10% easily down. Banks beginning to break down, and this started to happen recently. This is from last week. I didn't update it. The banks have been consolidating. People are waiting for some real news. And this is just a reiteration. The balance, credit card debt, total debt per capita by state, it is greater than 2008. So basically debt is driving this economy. And this is, so Baker Hughes, the rig count continues to trend down. It's stabilized, but it is actually trending down again. And oil has hopped up a little bit. We got 1 million barrels cut by a million. So they're just trying to maintain certain price levels. OPEC is. So we'll see. Like currently China's basically in a recession, and we're like having a decent economy. So if we get to coincide with everything open up at the same time, well, we're not expanding any capacity on the gas side. The new normal could easily be like $90 to $100 oil. The dollar index, I just updated this. It's same pattern. It's holding support. If we get a breakdown in the dollar index, the dollar getting weaker, you will see emerging markets do quite well. And this happened prior to 2008 crash. Emerging markets were raging, the dollar is weak. Then when the market credit spreads boomed out, then all of a sudden you saw the dollar actually flew up and emerging markets got crashed. And right before that, the home builders were rallying too. So everything looks good until it isn't. Unfortunately, it's like a last minute thing. That's why I've been so conservative in these videos over and over, saying cash is king, gold, Bitcoin. And same here, commodity super cycle. We're still haven't broken out yet. If we do get dollar weakness, like it looks like it, we might get a good shot at it. And Bitcoin as well as gold is implying that. But the demand out of China hasn't been like as strong as I expected, or I was hoping in a way that it would be strong, but at the same time, having lower demand decreases inflation potential. So I was happy from that perspective. Now looking at sentiment, you could see that sentiment is more neutral. It's neither real greedy or fearful. So everybody's complacent. That's how I would look at it today. Inverted yield curve, we're waiting for this to blow out, and the employment rate will at least shoot up to 5 to 5.5%. And at that point, the market will self-adjust, or it should have self-adjusted before. So this is a friendly reminder looking at 2000. And so it just shows all the corrections and bounces in the market from 19% to 31 to 14 to 19 to 28 to 4. think this is 41.11, 49. So there's going to be a lot of rallies and drops throughout this correction. We're kind of in this phase. So if I know this is 2020, but the fact is we're kind of in this period where like bottom out, it looks like we want to take off. Now if the Fed, it just really depends. The Fed's going to hold steady or raise rates, we're likely going to fall down pretty hard. It's inevitable. If they cut rates a whole bunch now, the market might react negatively short term, but I think we would rally, and especially if they did fiscal QE. But it looks like their plan is to really shock the system, move as many dollars from the debtors to the creditors, thus enriching those at the top of the pyramid, while cleaning out unhealthy corporations that shouldn't be in business regardless, really, because of easy money. So it's kind of complex, but given the approach they're taking, they are squeezing out the lower 50% of the economy, while they could directly target corporations more, or those with assets that would more directly impact inflation, like controlling money supply. Then we're looking at quad 4 investing. So if you look here, when the market corrected 13%, 18%, 16%, and down 2%, it was all quad 4 investing. And that's when the quad 4 investing is when it's investing in utilities, REITs, consumer staples, defensive stocks. While the high-flying momentum ones tend to do less better, like technology or small caps over the Russell 2000 during a bear market, which is essentially what a quad 4 is. So, the list. I haven't been playing with this list. I still see the same gold, Bitcoin, build up oil positions, have metal mine exposure, long term, looking out 5 years. Paramount Global, Warren Buffett, he tends to know how to pick them. I still like the shippers to a certain degree. These are unfortunately really micro cap type, but I just think long term it's a good play, looking out 5 to 10 years. And this oil, still the Canadian oil stocks like Surge is excellent. They should be on here and up here, I believe. And so that's all still going to come in play. HOOKIPA is on here, and yeah, I'm going to add another one to this called Peer Cycle, and they're a billion-dollar company with no revenue, but it's more of a risky bet. It's interesting one to watch. It's the opposite of Oxy or Valero. It's like what they are is a plastic recycling company that they're going to have facilities all over the world, and they're setting it up now, and they'll take hard plastics and recycle them. Pretty straightforward, but they have a patented technology that they got from Procter & Gamble, and because of that, it's not as costly to recycle hard plastics versus the other technologies people use, which is more chemical, versus this is less chemically driven. So without any revenue, it's like a $6 stock. It's just interesting. Yeah. So that is it right now. I mean, I think the gold miners are probably a good play. Like if you could accumulate 100 shares, or even the Bitcoin stocks could accumulate 100 shares of Riot. And then in 5 years or so, if this all plays out as I expect, you'll be able to write covered calls and collect rent on those for essentially owning those 100 shares. So think long term when it comes to these positions here. Same with Paramount, would probably be a very good one to do covered calls in as well. And next, and that's all we have today. So let's look at commodities. What's going on here? If we take a look at electricity rates, they are so volatile. I don't know where they get the data. I guess straight from Germany for the month is up well, it's flat for the month, but for the week, 18%. Well, Spain, supposedly their electricity is down 63%. Let's just look at the key points. Looks like for the month, livestock's up a lot overall. Eggs have decreased 27% for the week. Let's just focus on the week. So for the week, livestock is actually looking good for the most part. I mean, cattle's up a bit for 1 week, 2.59%, 7% for the month. So cattle as well as salmon are quite hot for the month. So inflation's ticked up since last week, just eyeballing this stuff for sure. So I don't know what's going on here. Why it would all in 1 week just kick up so much across so many things. But saying that, year over year, the numbers look okay, and most monthly numbers look all right for the most part. We have magnesium is up 23% for the month. Lumber's up 20%. Cocoa's up 15%. Sugar 16%. Orange juice 14%. Down is palm oil 7%. Tea is flat for the week. Yeah, so overall, ag is up a bit. Not what I want to see. So ag's up. Energy's up for the month. For the week too. Metals are down for the month, up for the week a little. Yeah, it looks like inflation's creeping back in just in the last week. I don't know how it could happen so quickly when we saw lending dropping off. So there's obviously stuff going on in the supply chains just looking at this, because the economy looks like it's contracting a little bit. So if capacity's shrinking too, then we're going to have costs go up. I know there was a dairy farm that had a large fire. So there's been a lot of things going on. So this is green bicep. The game plan here is the yield curve is still inverted. You want to protect your cash. Opportunities still exist in gold and Bitcoin if you look out 5 years. If we get rates higher for longer, we're likely market will clean itself out eventually. Maybe not till next year. Until then, it's a trader's market. You could be trading right now, doing quite well, or selling covered calls, collecting premium. Saying all that, I've been spending a lot of time in the last few days on Rocket Scooter. This is a company that will coach and train you on how to trade and invest. It's very short term, but it's very logical, and I've been looking at trading for over 20 years, and I've never been very good at it for many reasons. But this really is dialing everything in for me, so I could take what I'm learning here and apply it to other strategies if I chose to, or I could just use their strategy for their style. So it's invaluable. I would highly recommend rocketscooter.com. Matt is the lead guy over there, and I guess that's it for now. I appreciate your time. This is Green Bicep. Any questions, comment, hit me up. I'm here to do any sort of research if I have the time. I'm happy to look into anything that will help us out as a community. Take care. Bye.